So we are done in that question. We are done part A, which was goodwill arising on acquisition of investments in subsidiaries. So subsidiaries was Pamba and Dafu, so we computed that goodwill. So we are not going back there anymore. Part B, gain or loss arising on disposal of investments in Dafu Limited as reported in Roman 1, as reported in the individual financial statements of Pareto, and also in the consolidated statement of profit or loss. Also, those two, we were able to capture them. So those ones also we did. So we are not going back there anymore. So C, consolidated statement of financial position as at 30th June 2021. So that is where we were to pick up from. So just to bring us up to speed, we need to recall this, that Pamba, first of all, the year ends on 30th June 2021, 30th June 2021, meaning that that financial year starts on 1st July 2020. 1st July 2020. That is where it starts. So Pamba was acquired. Pamba was acquired on 1st of October. So Pamba was 9 months, was it? Yeah, it was 9 months subsidiary, while Dafu was disposed of. Check note number 4. Check note 4. Pareto Limited disposed of 60% investment in Dafu on 1st April 2021. Somewhere here. 1st April 2021. Dafu disposed. Dafu was disposed of. So they disposed of 60%, meaning they remained with 40%. And 40%, you know, that is an associate. Associates, we don't consolidate for them. So for the balance sheet purposes, we said we are going to check, so consolidated statement of financial position, we are going to take Pareto in full plus Pamba in full plus nothing only. So Dafu will not go to the balance sheet because at the end of the year, it had already become an associate. But we will consider our investment. You need to check how much investment do you have in that associate. So before we go to consolidation, I would want us to do 3 workings. 1, to determine our investment in the associate. 2, the retained earnings. And 3, the non-controlling interest. Then we are good to go. So allow me to start with the investment in associates. As working 1. Investment in associates. Dafu is the one which became associates. Yeah, so you come here and say original cost of investment. So the original cost of investment, you don't take when it was a subsidiary. See like example when it was 100%. check the investment which remained after we disposed 60. So after we disposed 60 is when it remained to be an associate. So you need to check the investment which remained when it became 40, how much investment remained there. So check note 4. I just want you to check, then maybe you can let me know what that figure could be. If you go around note 4, what do you think is the investment in associates? Remember, we disposed 60. After disposing 60, we remained with a certain value at 40%. So we assume that is what we are starting with at the associate level. So how much figure do you think it should be? You can just go through note 4, then maybe you can speak out. Somebody? Take that note 4. Remember, we initially had 100 to Kauza 60%. So when it remained 40%, how much of the investment remained at 40? So that is what we assume we have invested in the associate. You must see a figure there. In that note 4, it is there. Massive 43. Yes, it is 43. They have said Pareto, they have said the fair value of the remaining 40% equity interest was 43. So 43 is what we have invested, in that company. So it remained 43, and that is what we assume to have been the initial investment at 40%. Higher. Then you will add. You add post-acquisition. Post-acquisition net assets. Any net assets or profits, net assets, I don't say net assets because ordinary share premium remains constant. So what keeps on changing is the retained earning. So whether you say post-acquisition profit or net assets, the same thing. So what you need to check for me, do for me this favor here. How much was the net assets of DAFU on the date of disposal? Check that note 4. How much was their net assets when we were disposing them off? The net assets were standing at what value? When you go through that note 4, note 4 has everything concerning DAFU. How much was there? The immaculate 6250. When the fair value of the so the net asset of this date was 6250. So when we disposed of the 40%, the net assets on that date was 6250. Check the net assets at the end of the year so that I can get the increase. I top up to my 4300. So the net assets at the end, go to the balance sheet and the equity. Net assets are the equity. So check the total equity of DAFU, the total equity. So total equity of DAFU, you will see 8250. You will see there 8250. So the increase is what they made when they were associates from here to here. Shares and premium remains the same. So what the increase is actually the profit. So check the difference from here to here, then give us 40%. So you will take 40% of 8250 minus 6250. Only. There is nothing past that. How much? How much will that be? %40 of the difference should be how much? $800. Thank you. 800. Therefore, the total we are talking about here is 51. That is the investment which should go to the consolidated in the balance sheets at the end of the year. we were having 100, tukauza tukabaki na 43. So that 43, as time goes by, you keep on adding the profit. So don't say, why are you saying profit, but here you're talking of net assets. What net assets do you need? Ordinary, premium, retained earnings. Ordinary premium constant. Retained earnings is what keeps on changing. So when the examiner is just talking of net assets, when you get the difference between net assets, is just the profit you're working, because using it is constant. So this one will go to the balance sheet. So associate will appear in the balance sheet once the investment in associates. Fine. I want us to check retained earnings. So anybody who is not done there, kindly be faster so that we go to the retained earnings. So you are done with that. So part number 2, let's check retained earnings. Another tukianza presentation we are set. So retained earnings, consolidated retained earnings. Consolidated retained earnings. Shillings are in millions. Consolidated retained earnings, shillings are in millions. So you will give me the retained earnings of Pareto. The parent, check in the balance sheet. Check in the balance sheet under equity. That balance appearing down there.
$78.25.
So that one comes to 78.25. Then there was gain on disposal. When we disposed Dafu, there was a gain. Please, you will tell me how much. So they consolidated, but they were the same. I remember the figure was the same. So you add gain on disposal. Dafu. When parents disposed of Dafu, how much was the gain? We calculated it was part of the required up there. How much did we? Thank you. 1250. So you top up the 1250. But for the investment companies, we only add what profit which came after acquisition. What came after is what you take into consideration. So you'll come here and say, add post-acquisition profits. So post-acquisition profits, you will add for Pama and Dafu. So Pama, any profit Pama made after acquisition, parent will take 80%. So you take 80% because parent was controlling 80 minus the difference in profits. So Pamba, we can do this. Check here. Pamba was acquired somewhere here. So what you need to check, what was the profit on the date of acquisition? The profit on the date of acquisition, and what is the profit at the end? Then you consider this difference. So at the end is the one appearing in the equity, the closing in the balance sheet, which you can see 52.50. So this is 52.50 there. So can you go to additional information number 1? Just go through it pole. You will be able to see how much was the profit on the date of acquisition. Can you check for me that? People are seeing 35. So it means from the date of acquisition, they have just made the increase from here to there. So you take 52.50 minus 35. So 80% of the difference, what will you get? Mercy, 1,400. So this is 1,400. Then for DAFU we are going to split it into 2. Because you know DAFU was acquired a long time ago. Let me present it this way. DAFU you will bring DAFU as a subsidiary, and DAFU as associates. You will, when you dispose, you have to separate the 2. So it will go this way. You know, it was disposed somewhere here. So for this period, from here to here, the parent will take 40%. But from here to here, the parent was taking 100. It was 100% subsidiary. So you will play with those profits. But when you are very keen in DAFU, the examiner was talking much of net assets, not profit. But when you talk of net assets, changes in net assets is just profit. Because net assets is ordinary, share premium, retained earnings. But you see the ordinary, share premium, those ones, they don't change. What keeps on changing is retained earnings. So getting difference between net assets is just the retained earnings component you are looking for. So check this. Take for me the total net assets in the balance sheet of DAFU. We have even done it sometimes, 82.50. Then in note 4, on the date of disposal, it was 62.50. It was 62.50. So what I want you to do for me, can you check for me the net assets on the date of acquisition? This one we were not given, but we calculated the total when we were looking for. Come on, can you check for me the total the total net assets of DAFU on the date of acquisition, where we calculated goodwill? Yeah, that's where you get it. Check where we calculated goodwill, the total net assets, ordinary, share premium, retained earnings of DAFU on the date of acquisition. How much was it? Check where we calculated goodwill. Ilikuwa ngapi? Mercy is seeing 42.50. Someone else, just to confirm that we are all seeing. Nancy, 42.50. Yeah. So on the date of acquisition, when it was a subsidiary, the net assets was 4250. Date of disposal 6250. Close of the year 8250. So before disposal, from here to here, 100%. Here to here, 40. So you will take, when for a subsidiary, 6250 minus 4250. So that is gone. Then this other one is 8250 minus 6250. Give me those two answers. Yes, please. Yes. Okay. So Vera, you are being requested to mute. Higher. So 2,800 confirmed. Like that. Hakuna kitu ingine, tumemaliza. That is all. There is nothing else. There was no depreciation, no unrealized profit, no nothing. So give me that total. Then we finish up with NCI. Finish up with NCI. So give me that total. What did you do? Ukiona nini unaongeza kwa kesho. Wabeba kuongeza. So people are getting 13,275. Correct. If no question, let's work NCI, then we are done at that point. So if no question, then NCI's equity. We are checking at the NCI's equity. So NCI's equity, we are only considering NCI in Pamba. Pamba, remember, only Pamba. At the end of the year, we don't have minority in DAFU. DAFU is an associate. So we are only considering minority in the books of Pamba. So how do you get this? You start by saying fair value of NCI on acquisition. Please write that in full. Fair value of NCI on acquisition. When we acquired that company, what was their market value? Their market value is considered to be their capital. So how much was their fair value? It is somewhere. I want you to tell us. You tell me the figure and the additional information number. Note number 2, 21, 25. Yes. So the value of minority was 21, 25. Then any profits which the subsidiary will make after acquisition, you give minority 20% because parent was having 80%. So you add post-acquisition profits. You add post-acquisition profits. Post-acquisition profit in Pamba, check this one here. Pamba, parent went with 80% of this. So the same figure, minority will take 20%. So you take 20% of 5250 minus 3500. How much? Minority will go to 20%. How much should that be? 350. I'm told that is 350. So you top up 350. Therefore, total value of minority should be what they had on acquisition plus the profit that subsidiary made after, which comes to how much? 20 what? 24? 7. How much is that total? 2475. 2475. That was our working number 3. And we are done with all workings required. So unless someone has a question, ask, because balance sheet itateremka haraka sana. Balance sheet data itakuwa na story. So if you have a question, kindly ask. If you have a question, please ask. Ask before we proceed. Thank you. Seems no question. So let's go to presentation. Let's go to presentation. So in the presentation, remember now DAFU will not go to our balance sheet. So our balance sheet is only Pareto and Pamba. We don't capture associates and joint ventures in the balance sheet unless otherwise. You know the unless otherwise. So Pareto Group consolidated statement of financial position as at 30th June 2021. So shillings are in millions, like that. So be there so that we start non-current assets together. So there we go. There we go. PP, property, plant, and equipment will be 14,900 plus 9250 plus, what do you think I want to add? The last item there. What do you think I want to add there? What do you think I really want to add? Yeah, immaculate revaluation. There was revaluation in note 1, paragraph 2, correct? There was revaluation in note 1, paragraph 2, but which was not being depreciated. So you just add it the way it is. So plus 625. So 625 is the revaluation. So always be on the checkout for evaluation. So can you give me the total of PP? PP total will be how much? Somebody there? People are getting 24.75. So this is 775. And by the way, I was just checking something. I've realized this is the last time disposal was examined. Standing a very good chance. Next, investment. So investment in Pamba replaced with goodwill. So instead of bringing investment in Pamba, give us goodwill. So goodwill, we did it up there. What was the goodwill of Pamba? Check the figure. How much was it? You have all of them. It was required Roman 1, which we did. So how much did we get? Goodwill for Pamba was 3,000. 3,000. Then investment in Dafu, we have adjusted. Is the working one. Check our working one, the one we started with today. So investment in associates. In associates, working one. I can't recall here, 51. So we got 51. You're working one there. Then we have financial assets. Financial assets, those ones hakuna shida. Financial assets, you just add 31 plus 28. That is 59. So there is nothing there. Add. Can you add for me the total non-current assets? $38,775. $38,775. Then current assets. Current assets will be 3850 plus 4425 plus pick up a kwanza, then I'll tell you what we are adding. So I want us to read the very last note of note 4. The very last note of note 4. The very last note of note 4, they say, Pareto Limited has not accounted for the disposal. Pareto Limited has not accounted for disposal. So it means any item in relation to disposal has not been taken into consideration. That is what the examiner means. Any information as to disposal, they are not taken it. So now is when we are bringing them. So if they are not accounted for it, they now go up and check where question 4 started, note 4 started. Note 4 they said, Pareto Limited disposed of 60% of its investment in Dafu for shillings 4,700 million. So if they dispose it for 47, kwani wakidisposa si wanapewa pesa. So they received 47. So in current assets, if there was cash, then that 47 you add it to the cash account. But now because they just compressed everything as current assets, then that 47 you bring it here. Please indicate in your books what 47 is. 47 is the cash received on disposal of Dafu. So if you have understood, add for me the 3. People are getting 12,975. 12,975. For total assets, will be how much? Total assets, Jacinta, 51,750. Wow. Then let's go to equity. Equity and liabilities. So equity and liabilities. Equity and liabilities. So ordinary share capital and share premium, parent only. In fact, wacha nione kama kwani hata kama tuko na mbio. Wacha nione kama hata hii pia mnaweza balance hizi swali. Kwani kwa nini msibalance? Can you go to I want to guide you so that I see people telling me balancing. equity, ordinary, parent only, share premium, parent only, retained earnings, our working number 2. Then don't forget about NCI working 3. Letter hiyo. Then non-current liabilities, there is nothing, you just add the 2. Current liabilities, also you just add the 2. Can you do that? Then you check whether it will balance with the total assets. I give you 3 minutes. Please nifanyie hiyo. Chap chap. I can see people saying balancing. None of the balance, we check. If you have not, just say then we can check. Massive, not balancing. Let's check. Not checking. Jacinta, hebu piga picha hapo kwa Equity kuteremka chini, tutumie kwa group. Maybe Massive aone maybe there's something is missing out. Right away, please. Jacinta, do that. Chukua hiyo picha, tuone. Massive, check what she had shared. Then you tell me maybe where were you going wrong? Which one? Or you have seen the error. So just in case anyone, I hope that is okay. So the main issue when there is disposal of a subsidiary is just knowing that when it is disposed, you know, you can dispose and it still remains a subsidiary, so you have no problem. But if you dispose, it becomes associate or joint venture, then in the P&L, your portion up to the date of disposal. But in the balance sheet, you forget about it. Forget about it completely. Stretching out. So munaweza kunywa maji 2 minutes as I check for another question for you. You can relax 3 minutes. Be here by 6:23. Ndio tuendelee as I look for a question. Yeah, I got a question. This is November 2020. November 2020. November 2020, question 2. Question 2B. In my page is page 61. So I hope you are there and we can read the question. The question says, H Limited is the parent entity of a group of companies with two subsidiaries, that is S Limited and R Limited. Both subsidiaries have been owned for a number of years. So none was acquired within the year. A number of years means they were acquired before the beginning of this financial year. H Limited is the fine. So the following statement of profit and loss and comprehensive income relates to the group. No issue, no issue, no issue, no issue. Additional information. Story kwa hiyo story kwa mtihani isikushtue. Unajua hapa imekuwa compressed. In exam, hiyo kitu ni refu. Because the font size ni kubwa, so inakuwa refu sana. Isikushtue, there is nothing there. This story tumezoea, utasikia tu revaluation and realized profit, the common stories. So number 1, on 1st May 2017, kwanza tuko which year? Tuko 2020. On 1st May 2017, H Limited acquired 75% of the ordinary shares of S Limited, a public limited entity. The purchase consideration was cash of shillings 560 million, and the fair value of the identifiable net assets of S Limited was 400 million as at that date. The fair value of non-controlling interest in S Limited at the date of acquisition was shillings 240. H Limited wishes to use the full goodwill method for all acquisition. There was no need of telling us full because already NCI have been stated at their fair value. So once they state NCI at fair value, there is no need of telling us again full method. But good, those are what are making the additional information to look big. The ordinary share capital and retained profits of S as at the dates, as at the acquisition date, were 100 million and 200 million respectively, and there were no other reserves. The excess of the fair value of the identifiable net assets at acquisition is due to an increase in fair value of land, which is depreciated on straight line basis and had a 5-year remaining life as at the date of acquisition. So we will get that revaluation. There is revaluation which we are being denied. So we shall get that revaluation. Once we get it, we depreciate it for the 5-year period. So how will we get it? You will compare the net assets, the book value of the net assets against the fair value. So that one will check. 2, H Limited had acquired 80% of ordinary shares of R on 1st May 2016. The purchase consideration was cash of 600 million. R Limited's identifiable net assets had a fair value of 550 million, which was equal to their carrying amount. The non-controlling interest in R Limited had a fair value of shillings 150 million at the date of acquisition. On 1st November 2019, H Limited disposed of 30% of the ordinary shares of R. So R, remember, in note 2, we acquired 80, so they are selling off 30% for a consideration of 375 million. Okay. R Limited identifiable net assets was 675, and the non-controlling interest of R had a carrying value of 175 million at the date of disposal. The remaining equity interest in R Limited held by H Limited had a fair value of shillings 575 million on 1st November 2019. After disposal, H Limited would exercise joint control over R. Joint control because it was 80 minus 30, so remaining 50. So it has become a joint venture. Okay. The profits and losses of R Limited are deemed to accrue evenly over the years. So evenly, when they say that, they will just want you to apportion when it was a subsidiary, now joint venture. Number 4, H Limited sold inventory to both S and R at a price of 150 and 45 million respectively. In the month of October 2019, H Limited sells goods at a gross profit margin of 20% to group companies and third parties. At the year end, half of the inventory sold to S Limited remained unsold, but the entire inventory sold to R Limited had been transferred to third parties. So the ones which have been transferred to third parties, you don't calculate unrealized profit on that. Unrealized profit, you only calculate on the goods which remained in the store, the ones which were not sold, but the ones which have been sold to third parties, you don't calculate unrealized profit there. Goodwill arising on acquisition has been tested for impairment. Annually, and as of 30th April 2019, goodwill on acquisition of S Limited had reduced in value by 15%, and as of 30th April 2020, had lost further 5% of the original value. No impairment had accrued in respect of goodwill on acquisition of R Limited. Okay. And the interest in R, fine. So there is no impairment in R. R is the one which we disposed. Required, Roman 1, gain or loss arising on disposal of R to be presented on the consolidated, not individual, but in the consolidated statement of profit or loss and other comprehensive income. Then 2, consolidated statement of profit or loss and other comprehensive for H Group for the year ended that. Perfect. What I want us to do first, even before we check the gain or loss, is to calculate the goodwill on acquisition of these two companies. So write for me there, working one is goodwill on acquisition. Goodwill on acquisition. Goodwill on acquisition. So on acquisition, I want us to check for S Limited, and also we check for R Limited. So let's calculate goodwill for those two entities. All right, so we kick off. Purchase consideration. Purchase consideration. Note 1, let's check note 1. On 1st May 2017, H acquired 75% ordinary shares of S, a public limited entity. The purchase consideration was cash of 560 million. 560 million. Note number 2, H Limited had acquired 80% of ordinary shares of R on 1st May. The purchase consideration was 600. Or 600. Perfect. Then fair value of noisemakers. So fair value of NCI. You have the fair value of NCI. For note 1, the fair value of minority was 240. Then note 2, the fair value of minority was 150. So this is 800. This is 750. Less net assets. Less net assets acquired. So net assets on the date of acquisition in note 1, they said 560 and the fair value of identifiable net assets of S were 400. So this one here were 400. You subtract. While in note 2, the fair value of the identifiable net assets were 550. 550, you subtract. So the difference is goodwill. The difference is goodwill, in which case here, goodwill is 400, here goodwill is 200. There was no impairment of goodwill in R. So R, you can close. But S, proceed to note number 5. Proceed to note 5. Goodwill arising on acquisition has been tested for impairment annually, and as at 30th April 2019, 2019 is last year, goodwill on acquisition of S had reduced in value by 15%. So less accumulated depreciation. Accumulated means up for those prior years. So 15%, what is 15% of 400? What is 15% of 400? 15% of 400. $60. So we have 340. Then they continue by saying, as at 30th April 2020, which is our year of concern, 2020, had lost a further 5% of the original value. So less, sasa hii depreciation imetoka accumulated impairment. Tunaonea depreciation even where depreciation haiko. So less impairment for the year. To P&L. So this is what you take to the profit account. For the prior years, you don't bring it in the books. What you bring in the books is this one here. So they have taken 5% of the original value. Original value was 400. So they have not said 5% of the balance of the original value. So original value means we multiply on 400. So what is 5% of 400? So that is 20. Thank you. Therefore, net goodwill is 320. So this is what goes to the balance sheet. So that one goes to the balance sheet. Well, this one goes to P&L, other administrative. Impairment is classified as administrative. So when preparing P&L, this one goes to admin. Balance sheet, this one will go to the non-current assets. The other one was not impaired. So I think that was quite important for us. Quite important to us. So at this point, allow me to answer on one of the question, where they want us to calculate gain or loss arising on disposal. So gain or loss on disposal are limited. Good, we are there. So you start by saying, for shillings are in millions. Remember, this is required. So you start by saying budget proceeds on disposal. Proceeds on disposal. Check note number 3. Disposal took place in note 3. So we sold it for a consideration of 375. 375. Then you add. So I want my students to tell me what we are adding. What are we adding? What are we adding? Not the figure, but tell me in terms of wordings. You can even say wordings plus the figure itself. So what do we add to the proceeds? There is proceeds on disposal, 375. So what do we top up on top of that? Mercy, fair value of the net assets retained, correct, which is how much? So fair value of net assets or interest, whichever. Fair value of interest retained. How much was it in that note number 3? If you can be able to see it, just go through note 3 pole. But the disposal is likely to come in exam. Clearly. Predict what we are to predict. Lisa, Nancy, 575. Let me check. Note 3. Ordinary for 375. Unlimited identifiable net assets for 675. And am I on the right direction? Wait. Hedge disposed 30% ordinary shares of R for a consideration of 375. Perfect. R identifiable net assets was 675. And the non-controlling interest of R had a carrying value of 175 at the date of disposal. The remaining equity interest in R held by Hedge had a fair value of 575. Correct. 575. Good. This one here, 059. This one comes to 950. That is 950. Then now you need to subtract you less 1 unimpaired goodwill disposed. The goodwill which you are selling off. The goodwill which you are selling off. In R, goodwill is this one here. So unimpaired goodwill, unimpaired goodwill disposed. Just have there 200. I'll show you what to do. Unimpaired goodwill disposed 200. Then you less net assets. Net assets disposed. What was the value of net assets on the date of disposal? I've seen it in note number 3. On the date of disposal, not on the date of acquisition, on the date of disposal. On the date of disposal, the identified net assets were 675. So you bring here 675. But now, because we were not disposed everything, you will add. You add these two, you add the two, which gives you 875. However, there was NCI, you know, of this goodwill and even net assets, minority were also interested. So you less fair value of NCI on disposal. So on the date of disposal, in note 3, we have two fair values on acquisition and disposal. So you check on the date of disposal. In note 3, I saw it somewhere. Non-controlling interest in hand at a carrying value of 175. So carrying value, no problem. So of the total goodwill and net assets, 175 belongs to the minority. Meaning that the parent disposed 700. So here we have gained. So gain on disposal. Gain on disposal, we have gained 250. We have gained 250. Yeah, so something which I need to specify there. This is gain stock loss on disposal but consolidated. That is for consolidated. If it was in individual books, it becomes quite easy. You just take the proceeds, you subtract the investment which they have disposed of. Of course, they have disposed of 30% of their investment. So that one has no problem. Let's go to Roman 2, but before we go to Roman 2 of the question, there is something. There is something we have to check keenly. There is something we need to check before we go there. Some small issues. One, I want you to check for me revaluation. Revaluation. In that note 1, they were talking of some revaluation. I want you to check for me that. So revaluation, check note number 1. On 1st May, H Limited acquired 75 ordinary shares of Public Limited. The purchase consideration 5, and the fair value of the identifiable net assets stood at 400. So fair value was 400. Fine. Go to paragraph 2. The ordinary share capital and retained earnings of S at acquisition was 100 and 200 respectively, and there were no other reserves. The excess of fair value is of the net assets of acquisition is fine. So fair value of net assets, they have given us 400 less ordinary share capital. They are saying was ordinary share capital. They are saying is how much? Ordinary share capital is 100. While retained earnings on the same date of acquisition, they are saying is 200. So when you add the two, you know, when you add these two on the date of acquisition, they should tally. But now there is a variation. So this variation here, that is our revaluation. The excess of the fair value, that is what they have said. There was no any other reserve, meaning there is no revaluation and even share premium or so the entry had these two, ordinary and this. So when you don't have any other reserve, then it means this plus this should equate to net assets. But there's variation, which now is our revaluation. Therefore, so revaluation, I told you, some people will call it fair value uplift. So if you see something like that, one and the same, fair value uplift is revaluation. So kama kumtani kama utaki kuwa the same na watu wakinangana kusema revaluation, you can be saying fair value uplift. What unajua? Aya, so depreciation on fair value uplift will be 100 divided by 5 years. They say 5 years, if I can recall that. Yeah, 5 years. So it means we shall be charging 20 per year. 20 per year. That is okay. So for the balance sheet, so for P&L, no problem. P&L, you will be charging 2020, but balance sheet, remember this company was acquired in 2017. We are in 2020. So 2017, 18, 19, 20, 3 years. So for balance sheet, you will subtract accumulated of 60, 20 times 3 years. It was acquired 3 years ago. But for P&L, you only bring, you know, P&L is year-based. So you just bring the 20. And this 20, you take it to cost of sales. You add it. Depreciation in accounting, unless otherwise, we normally treat depreciation as part of cost of sales. Unless whatever kitu ingine, which I've never seen. So depreciation is taken to cost of sales. I'm just wasting time to look for kitu kitatusumbua huko mbele when we start. The last one we need to calculate is UPI, the unrealized profit on inventory. You will check note number 4. That is our last working. The unrealized profit on inventory. Unrealized profit on inventory. So unrealized profit on inventory, well, you hear both S and R. That is what they said. But the ones which were sold to R has already been sold to third parties. So you don't compute unrealized profit on goods to third parties. You only calculate unrealized profit within the family. So family is the group itself. So H Limited sold inventory to S and R at a price of 150 and 45 in the month fine. H Limited sells goods at a gross profit margin of 20 to companies. At the year end, half of the inventory sold to S remained unsold. So half of the inventory to S is the one they sold 150. And they were selling at a profit margin of 20%. So that is the unrealized profit. How much? How much, how much, how much? $15. Thank you. We are done. Can we do presentation? Yes, we can. So now I want to wrap here. So write for me there, H group. H group, consolidated statement of profit stock loss, another comprehensive income for the year ended, that one there. In fact, you want to take your heading, mean answer straight. So right there, H group, consolidated statement of profit stock loss and other comprehensive income for the year ended 30th April 2020. Write that heading and we kick off. But people are ready. So shillings are in millions. Okay, well, let's check something. When was R disposed? The year is ending on 30th April 2020. So this one starts on 1st May 2019. When did we dispose R? Check note number 3. R was disposed on 1st November. 1st November 2019. 1st November 2019. So initially we had 80% subsidiary. So in the P&L, we are only going to apportion for the period it was a subsidiary from here up to here. This other side, it has become a joint venture. We don't. So we only apportion here. In the balance sheet, which is not required, it will not appear there. We only bring the investment. So can you count for me from May to November? How many months are those? Na hiyo ukikotea tu pa, utarudi fellowship. Hiyo tu. So you have to be very keen. Unahesabu kwa vidole, see at 11 minus 5. So that you don't. How many months are those? Vera? 6? Vera, how many months? Well, 6 months. Yeah, May to November. So November is not included. So May, June, July, August, September, October. Yeah. So actually kwa mtihani hizo vitu zinakuanga 3, 9, 6. Those are the common. 3, 6, 9. Ukianza kupata vitu zingine ati 8. Though I've seen before, but check until you are sure beyond any doubt. Mostly inakuanga 3 months, 6 months, and 9 months. Those 3. Ukipata kitu funny, you check keenly, but those are the common ones. So for consolidation, H in full, S full, S was not interfered with, so H full, S full, R 6/12. So there we go. So we have revenue. So revenue, we add 4275 plus 2515 plus 1730 times 6/12 minus intergroup sales. Intergroup sales, whatever they sold amongst themselves. There was an issue with this question sometimes, but it has since been resolved. You know, there are goods they sold to S and R, but the ones they sold to R had already been sold by the end of the year to third parties. So it is assumed they are goods which were sold to third parties now by the group. So the contention was, do we subtract the entire sales to S and R? So upon further discussion, which makes sense. You know, when subsidiary wakauzia third parties, it's like the parent is the one who has sold to third parties. And what you sell to third parties, you're not supposed to subtract because it is not intergroup. So subtract only the goods which were sold to S. So to S, we sold goods worth 150. Yes, at a selling price of 150. Year 45, we agreed you are to a channel. It was 45 was subsequently sold to third parties. So there is no need of subtracting it from the group. So how much is that? Start with the 6/12. 6/12 is a half. So the best way is to start with 1730 divided by 2. You have 1730 divided by 2 plus this minus 150. Okay, we have to finish this question. So 7505. 7505. Then cost of sales, you will bring 2735 plus 1445 plus 10, 6/12 minus 150, the intergroup sale. So again, you subtract 150, then you add back the unrealized profit. So the unrealized profit was 15. So unrealized profit was 15. Then you add depreciation. You remember depreciation, so you can indicate in your books. This is depreciation, we add it as, you know, cost of sales is an expense. So we add it as part of those expenses. So this is depreciation, this is unrealized profit. Unrealized profit we normally add here to reduce the sale of 150 to cost. Minus 150 plus 15 will be minus 135, which is, it means cost is 135. So, no, this one you understand. So how much will the entire thing be? Jenga kumbe ulikuwa hapa 4570. 4570. Therefore, gross profit will be how much? Gross profit will be how much? $29.35, Hilda. $29.35. We proceed. Distribution. Power, no problem. I know what to bring. Distribution has no working, so you just add 305 plus 195 plus 90, 6/12. 96/12 is 45 plus this. What do you get? 545. Then administrative, admin, you will add 370 plus 235 plus 120. 6/12 plus impairment. How much was impairment loss? For the year, you know, there was accumulated and there was for the year. So for the year, the one I want. For the year, we got how much for impairment? 20. So plus 20. Please indicate in your books, this 20 is impairment loss. Impairment is classified as administrative. How much will the total be? So 685. So operating profit will be how much? $17.05. Then you bring gain before we go back to now there, gain on disposal of R Limited. The one which we just got here, it was 250. 250. Then R became an associate. So share of associates profit after tax. But the associate ama joint venture, sorry, it became a joint venture. Associates. It became a JV, joint venture. So share of joint venture PAT. So lighting labda ni punguze. Hivyo. Yeah. Good. So share of joint ventures profit after tax is 50%. times, check the PAT, hiyo inaona pretty good, then you go profit before tax. So profit after tax for R is 380. But it was a joint venture for 6 months. So how much is that? How much is that? $95. $95. Then finance cost. We have finance cost. Finance cost will be 45 plus 40 plus 30. 6/12. This one I can do. 30 times 6/12 is 15. 15 plus 45 is 60. That is 100. Copy at your own risk. Therefore, profits before tax. Profit before tax. How much? $195. From 1705, 1950. So this is 1950. Yes, I mean. Hey. That is 1950. Then income tax. Income tax is 160 plus 120 plus 100. 100 for 6 months. So that is 280 plus 50. 330. Confirm. Comes to how much? $1,620. Then there is other comprehensive income. Other comprehensive income, gain on property revaluation. So gain on revaluation, you add 150 plus 80. Yeah, 150 plus 80, that is 230. So total comprehensive. Total comprehensive income, we are talking of 1850. So we want to share these two profits. You share the 1620 and the 1850. So profit after tax to NCI, then holding company, 1620. Total comprehensive to NCI holding company, 1850. So have that, then we share it out, then the question is done. So it will to make our work easy, we will normally start with PAT. Whichever is the nearest method of flow out. So let's check. Let's have a working NCIs as a working PAT. NCIs PAT. So NCI, they only take profit after tax in the subsidiaries. So I'll have S and R. They only take profit after tax in the subsidiaries. So you take the PAT of these two companies. Remember, for R, you take 6/12. So for S, I'm saying for 80. For R, you will take 380 times 6/12. 380 times 6/12 to get 190. Then I will less depreciation. Depreciation was here. I will not subtract unrealized profit because H is the one who sold, so it does not affect the profit of the subsidiary. Then impairment, yes, it was full method. So impairment for the year was 20. It will also affect the minority because minority contributed to goodwill. It was full method. So they will also suffer the impairment. So nothing else. This is 440. This is 190. Minority in S minority were entitled to 25 because parent was taking 75%. Then in R, before disposal, in R they were entitled to 20. So you give me 25% of 440, that's 110, just check. Then the other one. Give me the two figures. 110.38, thank you. 110.38. So this is 110 plus 38 is 148. So that is what goes to the minority in terms of profits. So parent will take the total 1620 minus 148. Subtract. $14.72. Let's go to total. How did we get the total comprehensive of 1850? We took the consolidated profit after tax plus revaluation. So the same thing happens there. You take what someone, so someone here is the NCI and parent, what someone has gotten on PAT, they have gotten 148. Then for revaluation, you see we have parent 150, subsidiary 80. So minority will only take their percentage of 80. They only take what is in the subsidiary. They will not come to the parent. So you take 25% of the 80. So plus 25% of 80. They don't go to the parent. Parent will take the entire 150 plus their percentage of 80. So 25% of 80 plus 148. What do you get? $168. So parent will take 1850, the total, minus 168. Like that. How much? $16.82. And we are done. We are successfully done with that question. So I'm leaving you with one question, which utafanya tomorrow, where we'll start from tomorrow. Let me leave you with one question on disposal. No disposal. Nakaa wanaweza leta kwa mtihani. Wakileta, wapate kama tuko, we are ready to face them. You will check for me December 2017, question 1B. Page 96. Page number 96. So that is what we'll start with tomorrow. So tomorrow tutaanza hiyo asubuhi, tumalize na tuanze foreign subsidiaries. Yeah, that is the highlights. So otherwise, for those who are not there, in the last class, I had requested to stop early for some functions. So we are stopping at that stage.